Welcome back to another episode of the Lender Podcast. I'm Bryce Matheson, and as always, this episode is brought to you by Lender. Lender is a loan management software tool designed to help you with every aspect of your business, from origination to servicing to payoff. Lender helps you with document generation, helps you with collecting monthly payments, dispersing monthly payments to your investors, taking in new loan applications, giving your borrowers a portal that they can log into, giving your investors a portal that they can log into. Pretty much every aspect of everything that you do inside of your lending business can be done and facilitated through Lender. You can check that out by going to joinlender.com. That's LENDR, joinlender.com. Now, onto the episode. So I just got back from the Paper Trail Note Investing Conference, which was actually really convenient because it was in my own backyard. So we're based out of Phoenix, and it was here in Chandler, Arizona. And so I was invited to speak on a couple different panels, but while I was there, obviously I was exposed to a bunch of other stuff surrounding, note purchasing and NPLs and all these different things that honestly it was a little bit eye-opening, but at the same time, it also kind of made me really grateful for private lending and the way that we do things. So anyway, I have a good friend, Beth Johnson. She was a part of the Lend to Live community, if you're a member of that on Facebook. And she's kind of starting to get away from like coaching and consulting, and she's been really big in the community as far as like helping private lenders kind of get started and finding their way to get started in private lending and all those different things. So anyway, she was invited to speak at this conference, and this was kind of her last hurrah. Now she's kind of pivoting and doing some different things, but she invited me to come and be on these panels, like I mentioned. The majority of the conference was talking about notes related investing. So purchasing already existing notes that you can just hang on to for 10, 15, 20, 30 years, whatever. And it's just a great stream of passive income. And I learned a lot of different things. And it was kind of funny because a lot of the metrics were different than I was expecting. For example, like in our world, we talk a lot about loan to value and LTV, and they were talking about all these acronyms and they said ITV. And originally I was like, what are you talking about? Like, you have the acronyms wrong. It's LTV, not ITV. And come to find out, it's investment to value as opposed to loan to value, because they're not dealing with loans, they're dealing with notes in the original investment. And then they started talking about NPLs, and I'm like, no, it's PML. Private money lender. And then, come to find out it's non-performing loan instead of private money lender. So it's a totally different world. And it's just funny because I was thinking that I knew all the acronyms, and I clearly didn't, because this was a note investing conference. Now, like I said, there were a lot of things that I took away from this conference that both were reaffirming in the way that we do private money, but also was really good because we talked about some of the different current like market economics that a lot of people are seeing right now. And I think it still applies to just investing in general. And so I think a lot of those takeaways will be beneficial to you. And then I've kind of got some strange, like just kind of one-off ad hoc quotes that I wrote down because I was like, ooh, that's a good way of thinking about it. So I feel like this episode is going to be a little bit scrambled, and that's okay, because it's my podcast. And if you don't like it, you don't have to listen. You can turn it off. But I still think it'll be semi-cohesive and somewhat valuable to people. So the first thing that I really realized is that I prefer private lending. And the biggest thing with that is because I have full control. For example, when you're purchasing a note, somebody else has already originated this loan. And that note may be somewhat stale in the sense that it may have been serviced for the last 5, 6, 7 years. And so, as you're purchasing these notes, there's a due diligence package oftentimes that comes with it that says, this is the collateral and this is the individual and this is their underwriting criteria and this is how we underwrote it originally and all that different kind of stuff. But the problem is, let's say you're purchasing a note that's been performing for 10 years or 12 years, that data is stale. Whereas in private lending, you have full control. For example, you are underwriting the property, you're doing the due diligence. When you go to purchase it, you can see like how seasoned it is, how many payments have been paid. There's just a lot of different things that, in my opinion, are pros when you're private lending. And that's why I prefer private lending as opposed to purchasing existing notes. On top of that too, I started to notice that the average interest rate that most people are purchasing these notes at are around like 7 to 9%, maybe a little bit higher than 9, maybe 9.75. And for me, at least in my opinion, that's quite low, mainly because in addition to charging, typically 12 to 14% on the short-term loans that we give to borrowers, There's also extra fees. There's origination fees. There's doc prep fees. There's legal fees. There's additional commitment and junk fees. There's extension fees. There's all these different things. And so it really becomes an incredible investment opportunity, an investment vehicle, because it takes a 10 to 12% annualized return and bumps it up into 15, 18, sometimes greater than 20% annualized returns because of all the additional fees and things like that. And on top of it, I feel like there's a little bit more control because I'm the one who originated it in the first place. And so I'm not going to originate a bad deal where the numbers don't make sense and the things like that. And so I can see this kind of holistic view when I build and originate my own loans, as opposed to buying something that somebody else did, which I have no idea what the holistic picture is. On top of that, too, when you're purchasing notes, there's a little bit of a disconnect. For example, like when I'm issuing a loan to a borrower, I have direct contact with them. I am talking to them on the phone, or at least chatting or direct messages or something at a minimum. Usually, almost all the time, we get people on the phone and we kind of discuss things. Whereas if you're purchasing a note, I feel like a borrower may be like, "Why are you calling me? Yeah, who are you?" And like, I've been paying on my note for 12 years. Like, who are you? So there's just that disconnect. It's not as intimate. It's not as close. And I don't really love it. So anyway, all that to see, there's a lot of power and a lot of control that comes with private money. And so as I was going through this entire conference, I really found that, I really do prefer the way that we do it as opposed to purchasing notes. Now, the one downside is it is very much an active business. There's very little, if anything, about this business that is passive, whereas note investing is quite passive. You purchase the note and you collect your checks. So there is something for that, but personally, I'm a big fan of active income. I used to be this huge proponent of passive income and, making all this money without having to do any work. And now I think that's bullshit. I truly don't think that is a thing at all. In fact, I heard a quote this weekend, which I thought was really good. It said, "There's not a passive way to build passive income." There's not a passive way to build passive income. And I thought that was really, really good. Everybody talks about passive income, but truly the only thing that I can think of that maybe is 100% passive is like earning dividends from stocks. But even then, you have to have some sort of active income to build this massive lump sum of capital to purchase that in the first place to be able to generate those returns. And so I don't believe in passive income anymore. Anyway, that's kind of a side tangent. I digress. But it really just made me realize, like, yeah, there are more and less passive ways to do things, but I think I greatly prefer the private lending side of things. It's a little bit more active, but the returns are significantly higher. I feel like it's a little bit lower risk, and then you can just kind of get that capital back, rinse and repeat, and go on to the next one. Okay, one thing that they did talk a lot about that I felt was valuable to myself and to you as well is that there was a lot of talk about current market conditions and just what everybody was seeing. And whether you're a private money lender or a note buyer or whatever it may be, the market conditions are equally the same and they affect you the same. And so I don't think that any of these would be a surprise to anybody, but still good to reiterate. So a couple of the notes that I took down, a lot of people are saying that they are finding a lot of people who are in a bind. There are a lot of people right now who are equity rich and cash poor. And equity is great, net worth is great, but cash flow is still always and forever will be king. And we find that as interest rates increase, cash flow typically decreases. And so again, that shouldn't be a surprise, but a lot of people are seeing that. There's also a lot of scarcity and there's a lot of people who are trying to unload deals. So for example, if you have a big portfolio, a lot of people are trying to cash out or basically just break even or something because who knows what's going to be coming in the future. And so a lot of people are saying, I used to have this deal or I had this like longer timeline where I could wait 3, 4, 5 years to maybe see how this pans out. Now people are fine with breaking even or even taking a slight haircut just to unload these deals because the market is uncertain and nobody has any idea what's going to happen. With the changes in the interest rates and the Feds, with that most recent cut, I do think there's kind of a light at the end of the tunnel. I think we are going to stabilize a little bit more, but who knows, and so people are being a lot more conservative. And if you have something that's a little bit volatile or something a little bit more risky, we're seeing people who are starting to want to kind of unload those and move on to different projects. Again, kind of to reiterate, we just talked about this, but rates are a little bit lower than they have been, but they're still relatively high. And so people are being a little bit cautious with that. Seller financing is increasing because people are shifting towards non-traditional lending because banks have really tightened up their purse strings. So that's good for us because people are searching for alternative forms of financing, which is seller financing or a private money lender or a hard money lender, which is really good. That's more business for us, but still makes you a little bit more cautious. If banks are tightening their purse strings, maybe we should too. I don't know. No like luxury high-end anything. And this is a big one. For example, in the past, like 2022, 2023, when the market was just going up, up, and up, even if you had a bad deal, it would still kind of absorb those losses just because the market was increasing so rapidly. And so you could buy a bad deal, for example, that, I don't know, maybe you're 10% underwater. By the time you fixed up that property and went to sell it, 6 months later, you made a killing. And it wasn't even a good deal. It wasn't that you're necessarily a good or a smart investor. It's just the market propped you up and you got lucky. Now we're not seeing that so much. A lot of things are seeing price drops. And so because of that, we are not doing luxury anything. We are not doing any high-end flips. We are not funding any like remodels down in the historic district right on the water where these property values are, $1 million plus. Like we're not doing any of that. Everything that we are doing right now is at the median or below. And that's just because if there is a massive market correction, those are impacted as little as possible. And so that's where we're really focusing. Last thing that we kind of talked about is, for the most part, we're not really doing commercial anything. And that was a general consensus across the entire room. A lot of people are saying, like, we are not doing strip malls. We are not doing retail. We're not doing any sort of like office space or office building. There's a lot of like, return to office mandates, but it still makes me a little bit nervous. And so we're not doing any of that. Mixed use, I'm more comfortable with that. Like, for example, you may have a storefront in the front and then you may have like apartments on the back of the building. I'm okay with that. I think that's a little bit more insulated. But larger multifamily, I'm still okay with it. Smaller multifamily, absolutely, yes. I think that's still a buy. Self-storage is okay. I think that's one of those things that people would cut in the event of things getting really bad. Is like, it's very easy for you to just close up your storage unit and not have to pay that, $200 a month or whatever you are on a recurring basis. So, people are still being cautious. Commercial, anything, 100% commercial. I see a lot of people not doing that. Mixed use or small balance commercial, I think that's a little bit more okay at the moment. Also, a lot of people are noticing that previously, like LTVs on commercial properties from banks, those have dropped from, 60 to 65%, now down to 50 to 55%. So if you have a borrower who is hoping to use private money or hard money and then go and refinance that with a bank, you better be damn sure that those numbers make sense, because if they cannot refinance that property after everything is stabilized and ready to go, well, that sucks. You're going to be having to figure out some sort of a payment plan or something, or potentially taking this property back in foreclosure if they walk away with it, and now you're upside down. So I would be very, very, very careful on those numbers. Okay, couple quotes and different things that I wrote down just as I was attending the different sessions. Again, these are just random kind of ad hoc and one-off things, but I still thought they were really valuable as I was attending the different sessions. These were the ones that stuck out in my mind. So if they're useful for you, great. One thing that somebody said was, some of the best deals are the ones that you don't buy. And I really liked that. I was like, ooh, that's punchy. I thought that was very impactful because it's so true. 100%. It's very true. Like as private lenders, we're always constantly trying to like see if we can kind of force this to be a deal or make this work or whatever. And sometimes it's just out of desperation. Like we've got capital sitting on the sidelines and we need to deploy that. But I found this to be very true as well. There have been dozens of times where I've seen a project that ultimately we passed on and it turned out to be a really good thing. So some of the best deals are the ones that you don't buy. This was an interesting one. Somebody said, if the deal's not good at 13%, it's not a better deal at 18%. If you're not going to get paid at 13%, you're not going to get paid at 15% either. Effectively, they're both 0%. This was really good to me. I thought, a lot of people will do that. For example, if a deal is riskier, they will charge a higher interest rate to account for that risk. But one thing that a lot of people don't think about is, if you're not going to get paid anyway, it doesn't matter if it's a 2% loan or a 200% loan, you're not going to get paid regardless. Risk is risk. 100%. Risk is risk regardless of what the interest rate is. So sure, I guess if you want to, you can charge a higher interest rate to account for that. But if you're not going to get paid, you're not going to get paid. So I thought that was a really interesting perspective. Really good quote. Another little tidbit that I picked up, they said note investing, like seller financing, has an exemption for the Dodd-Frank Act, which we have to adhere to in private lending. I didn't know that. I thought that was really interesting. Again, I'm not a lawyer, an attorney, so maybe that is something that you need to look into. But the Dodd-Frank Act is what we have to adhere to and abide by with like owner-occupied residences. So just something to look into, but I didn't know that. One thing that I rarely do is refinance out another private lender. I thought that was really interesting and probably a good rule to abide by. More often than not, we see a lot of people who will come to us and they're using a Kiavi or a Lima One or some of these other like big lenders, or it doesn't even have to be like a big institutional national lender. It could just be another private lender in your town or city or somewhere in the country. But it could be a red flag or kind of a warning sign if they're with a private lender and then they're trying to refinance out with you. And mainly that's because something realistically probably happened with this project. They're coming up on this one, and the original private lender said, hey, we're not going to extend this or refinance or re-up terms or anything like that. You're going to have to find some way to get out of this. And so oftentimes it's desperation. They'll come to you saying, please, please, please save me. They typically don't say that. They'll kind of hide behind their existing loan and say, oh yeah, it's just coming due and we need to, figure that out. But I think it's worth asking those questions like, okay, can you not re-up with the existing lender? That's not to say that it's 100% catch-all, like this is a necessarily a negative thing, but I would dive into that a little bit deeper and see if there's another story or something there to figure out why they're trying to pay off another private lender and use your funds in place of it. Last little thing that I picked up that I thought was really good in one of the sessions, we get this all the time because we are relatively on the higher end of interest rates. So we charge 3 and 14. A lot of borrowers will call us and they'll say, are your rates negotiable? And one of the private lenders that was there, I know it's a note investing conference, but there were a lot of private money lenders there. And so, there were some sessions for private money and note investing and all the above. But this particular session that I was in, this private lender, he said, whenever somebody gets him on the phone and says, hey, are your rates negotiable? He says, sure, of course, I can go higher if you want to. And I thought that was interesting. He said most of the time it just kind of like, it stops people in their tracks and be like, okay, fine, I get it. So anyway, little tidbit. I thought that was kind of a funny little quote there. Okay, 2 last little things. And again, I realize this episode is all over the place. This is just kind of my key takeaways from this conference. There was one session that was, I can't remember the title of it exactly, but it all boiled down to essentially, if you can only pick one, are you going to bet on the jockey or are you going to bet on the horse? And the jockey is obviously the operator, you, the rider, or is it the collateral? The horse? Is it, is this going to be a win-win deal because of the horse or because of the operator or the borrower? And so really good session, but there were 2 key takeaways that I took away from this. There was one of the panelists that said, look for the things that the people are not saying. And she said one of the main things is she looks for personal responsibility. So oftentimes you'll have a borrower who will come to you and you'll say, hey, what happened with this project? And oftentimes they will say, well, the realtor this or the contractor that, or, this guy really screwed me over or this messed it up. And ultimately the panelist just basically said, like, you didn't learn anything. This is your fault. I want to see a borrower that comes to me with personal responsibility and be like, yeah, we screwed up. Like we didn't pad our numbers enough to adjust for a market correction, or expenses were significantly higher than we thought they would be. And that's on me. I should have done a better job. I should have added a little bit more of a buffer. And so I thought that was really good because I do have borrowers that come to us all the time that said, yeah, I lost a ton of money because this contractor kind of screwed me on this foundation work that we did, verbal or nonverbal, whatever it is. She basically said, just look for the things that they are not saying. Are they taking accountability? So that's one thing that I'm going to work, do better at. And then last thing from this session that I took away, somebody said, one of your superpowers has to be the ability to read people. You'll never be 100% right, but if you're trying to hone a skill, this is a good one. And he said it was kind of annoying too, because like they'll be walking through the store and this guy is like always analyzing people, and his wife was like, would you just stop it? Would you just quit? But I think in this lending business, you do have to analyze people and you really have to see like, what is this person going to do? And I found this particularly useful as a landlord. For example, when we had a unit that was vacant, we would go in and we would vet the renters and see like, hey, are you going to be a good tenant? And anybody who had a sob story, like, hey, we're getting evicted because this and this, or this thing happened. And this kind of goes back to the first point with personal responsibility, but it really comes down to like, just what kind of a person are they going to be? Are they going to operate well? Are they going to handle this situation well? Are they going to handle the circumstance? Any sob story for me, honestly, is kind of an immediate disqualifier. If somebody has an excuse or some reason for something and they're just not willing to take personal responsibility, then we're not going to lend to them. So anyway, those were the main key takeaways from that particular session. Okay, last thing, and this is like going to be very, again, scattered. I apologize, but there was one session where we were talking about how to find, meet, and vet fund managers. And I actually have another podcast episode where I was a panelist with Kevin Kim and Gerard Figarelli, both of which are incredible fund managers. And so I'll post that as a podcast episode here in a couple of weeks. But this was a different session, and you may not have a fund, but I see a lot of private lenders who they start doing the direct placement or the co-lending model. And then from there, they kind of slowly grow into this fund type model. And so these were some of the key takeaways from that fund related session. Okay, so one thing that somebody said was you don't want to go into a program that's too hands-off. You want some reporting, you want third-party fund administration, you want investor relations team, you can get the principal on the phone for a meeting, you have audited financials, and have an attorney look at the prospective PPM. So think of this in the context of you investing your money with a sponsor or with a fund manager. Basically, if you're going to be an investor in a fund, how do you know whether or not this is going to be a good opportunity or, your money is at risk? So they said, you don't want to be 100% passive. You don't want to be completely hands off. If you're placing your money with them, you want to have reporting. You want to have a third-party fund administrator. So it's not just the operator who's doing all of the books and everything like that. Have somebody else who's doing all of that administration outside of things. You want to have an investor relations team, somebody who is constantly like following up and sending out reports and checking in and just making sure that everything is going well with your capital. You also want to be able to get the principal or the sponsor on the phone for a meeting if you want to. If the sponsor or the fund manager is too high up the food chain and you're kind of like a peasant or a peon and you can't meet with them, that could be a red flag. Audited financials. This for me, honestly, it's a nice to have, but it's not a requirement. And a lot of people are like, what do you mean you don't want to have audited financials? Of course I do. If they're available, yes, 100%. Please send them to me. I want to review them. The asterisk with this is for a 506B or a 506C, it's a good idea, but it's not required to have audited financials. And so this to me is not a disqualifier. Again, very nice to have, but because of those like regulations and the rules around 506B and 506C, if somebody doesn't have audited financials, it's not a huge red flag for me, especially if they're on the smaller end. For example, if you're 3, 4, 5 million in a fund, that's a relatively small fund. If you're a $50, $100 million fund, okay, maybe that warrants audited financials. The main thing is that there's a large cost to audited financials. And so if you have somebody who is doing that, a CPA, whatever, and you're in a relatively small fund, that could affect the returns. And I can understand why somebody would not want to do that yet at a smaller scale. Okay. One of the things they said was don't let returns overshadow the correct infrastructure. If you're not receiving K1s or 1099s annually, that's a huge red flag. This should be a no-brainer, but they gave an example and they say like, we had this guy, for example, that was in a fund and he just kind of trusted the people. He like kept asking for like tax forms and stuff like that. And like, oh yeah, we'll get that. And after like 3 years, the guy didn't have any tax statements with the fund that he was in. And I'm like, what? Like, how does that even, I don't know. That was like insane to me, but that should be a big red flag. If you're not receiving regular statements plus like annual financials that you can, file yourself with your taxes, that's kind of a big deal. The other thing they said is ask to see a loan tape. Like, why is this particular borrower in here for 36 months? Why are you so heavily concentrated strongly in this one particular city? If you have 90% of your loans in new construction in Austin, Texas, that may be an issue. So a loan tape, if you're not familiar, is just like basically a big Excel spreadsheet that shows like, these are all of the loans, these are the borrowers. Basically, what is the makeup of our fund? It consists of all of these loans. And you can ask for a loan tape. For example, we have that readily available inside of our investor portals, inside of Lender. And so I would absolutely check and ask for a loan tape and then kind of critique it a little bit. Like if you see that there are 20 loans in the portfolio, 10 of which are all with the same borrower, that could be a red flag. Like they said, if you have 90% of your loans are new construction in Austin, Texas. As we know, real estate is hyper specific. And so if you're geographically concentrated in this one particular area, that could be a red flag. So concentration risk is a real thing. Concentration in and of itself doesn't scare me. I just want to see that we're diversified enough to offset the concentration of these other loans. So, okay, here's another one that I think is a really good thing. There is something called a fund of funds, and you may or may not be familiar with this, but basically, let's say I'm an investor, I invest my money inside of a fund, and then that fund takes that capital and goes and invests in another fund. They said, this is not necessarily a disqualifier, but it is a little bit more risky because now you have two sets of due diligence. You have to underwrite the fund that you're in, and then you also have to underwrite the fund that your fund is investing in. And so it just becomes incredibly risky, and there's just lots of additional room for error. And so again, not a disqualifier, but if you are investing your money in a fund, maybe these are things that you should take a look at. I thought this was really interesting. They said, most people don't wake up and say, I'm going to run a Ponzi scheme today. I thought that was really interesting. He said, it's usually that their ego gets in the way and they start borrowing from Peter to pay Paul. I thought that was a really interesting quote. I think it's true. I think most people, when they're operating a fund, do not wake up and say, you know what, I'm going to generate a Ponzi scheme today. I'm going to do this. I'm going to, fraud all of these investors out of their money. I don't think people intentionally set out to do that. Maybe some people do. I don't know. But he said it was interesting because more often than not, watch what happens to their lifestyle. If their lifestyle for your fund administrator or fund manager suddenly becomes highly inflated, that it wasn't like before, most of the time these people have an ego and they have these appearances that they need to keep up. Again, not a disqualifier, but just a little red flag. He said more often than not, something happens. There's one project that goes south. And so you start borrowing from these funds over here to keep this project afloat. And then pretty soon it becomes this just big domino effect where everything comes crashing down. So something to think about. One thing that was really interesting too, and this is something that I need to be better at because we don't currently have this in our PPM, is there a succession plan? So say, for example, I get hit by a bus. What happens to me? What happens to the fund? What happens to my capital? What happens to this? Does the fund continue operating? Does it get dissolved? Are there other people who are going to continue to operate the fund? So just a couple little things to think about if you are taking that money and investing it in other people's capital or in other people's funds, excuse me. I think this podcast is specifically catered towards private lenders who will be operating their fund. And so this is from the perspective of, hey, I'm taking my money and investing it into these platforms. But as a fund administrator, if you do operate a fund, these were all really good, valuable insights for me because I'm like, ooh, do I have all of these things in place for my own personal fund with my own investors? And so it made me kind of rethink things. So for example, I'm going to go back and update our PPM and add a couple of different things to the PPM to state this is what happens in the event of my death or something happens because your capital is still at risk. So we'll add some clauses we'll probably wait for the terms to mature, have those projects pay off. Maybe my wife or somebody else would handle that. And then the fund would eventually dissolve, and then we would take that capital and give it back to the investors. So all that to say. Okay, that is a very sporadic, disconnected podcast episode, but I think it was still really good for me. I really enjoyed the conference. And even though, like I said, it was heavily focused on note investing, there were still a lot of key takeaways that I was able to apply to our own private lending business. So the next couple of episodes that are going to come out, I was personally on two different panels. There was one where we talked specifically about private lending, which was really good. And then there was one, like I mentioned, with Kevin and Gerard that was mind blowing. I felt just kind of as I was sitting there, I'm like, I have nothing to add. Honestly, I don't know even why I was on the panel because these two were just genius. Gerard, for example, has operated multi-million-dollar hedge funds on Wall Street. Kevin is a fund and securities attorney. We've actually got him coming on the podcast in a couple weeks, so stay tuned for that. So just incredible, lots and lots and lots of good information. So if you're interested in setting up a fund, definitely stay tuned for those episodes because they will knock your socks off. So, okay, that's it for this week's episode. Thanks for listening.